Hello YouTube. The S&P just printed a new low of the year. We were trying to save 362.17 and now the S&P has printed a low of 360.87. So yesterday we closed at the lowest level in 2022 and now we have an even weaker close, down by about $1, and a lower low with a bearish engulfing candle on the daily, which we already know is happening on the weekly and also on the yearly. So why is this so important? Well, yesterday we talked about two charts that were breaking, and because the S&P is a composite of 500 stocks, meaning some technology, some finance, some industrial, some energy, it is going to be the best gauge for the broader market. What I want to do now is just remind you of what we looked at yesterday. We looked at the Dow, and here we were looking at the 200 weekly moving average, which is going to be the black line and associated with the black number here. So that's 297.78. Last week we closed below, and now we're well below, and we're now also below the weekly low. So that's what we noticed on the Russell yesterday, where we can also note that now do we have a new low of the year, 16278? No, we don't quite have it, but we note that we are well below the 200 weekly, which only happened last week, and now we are below last week's low with a weekly lower low and a weekly lower high. If this confuses you, don't worry. There's 2,000 stocks inside the Russell, and these are small companies, which means they're generally competing more on price. They're not an Apple where if you want that iPhone, it's either you buy it from Apple or you're not getting it. These smaller companies have to mostly compete on price, which means it's a race to the bottom. So now that the S&P is printing a new yearly low, let's go back to this chart here to look at SPY. We're going to look here and just note that, yes, this is scary. We are technically right around last week's low at 363.29. I'm paying very close attention to that level. You can also note here that that is where we get our support and resistance areas here. So now that we got all the way down to 360 or to S3, what is still holding us up? Because if we understand what is holding us up, it'll actually provide a very good clue for where we need to go. Now we're going to look at one more chart here, which is going to be the Qs or QQQ. And we look here at a weekly chart, and what was missing last week for me was a true test of the 200 weekly. Well, we got that now. The low is 272.11, and the 200 MA is currently 272.45. So the black line with a black number, which means that last week we were off by about 9 cents to hit it. Now we actually hit the 200 weekly. So if people were waiting for a perfect test to come in and buy it up, well, now they got it. We also maintained a higher low. So this is the chart that really is the last one holding here. We also note that we have a higher low versus our low established in June, 269.28. Here we got 272 and 272. So QQQ or the Qs are the last one holding up here. So we really have to pay attention to this QQQ weekly chart as we go into the rest of the week, but frankly, the rest of the year. Because right now, what is really holding these up is what held up today. What? Yeah, well, Apple was green, Tesla was green, Nvidia was green. Oh, so if we understand that, yes, that's what's holding up the market right now. And when we go back to our heat map here, and we sort this by, we go here to no group, which means just by weight. So again, the S&P is a weighted ETF. Apple, biggest block. Microsoft, number 2. Google, Amazon, Tesla. So on this side over here, it doesn't look all that bad. Over here is where it starts to look a lot more mixed. So where we're going to go, I think is going to largely depend on where the Qs go, the QQQ. And that's really going to depend on whether or not we see a breakdown in Apple, a breakdown in Tesla, a breakdown in Nvidia. And the reason why is because these are the ones holding it up. So as of right now, when I look at the market leaders here, I got Apple. Well, Apple's got a higher high and a higher low with an inside bar. And it's green on the week. That looks bullish. Cool. Okay, let's look at the next one. Microsoft. Well, a little stinky here from Microsoft, right? Little stink. And we note that by the head and shoulders we noted, rejecting off the 50, lower low, but it's maintaining last week's low. That's about it. Next one here, Google. Well, Google's already fallen from grace, right? Right around last week's low. Above the 200 weekly though, and just doesn't look great because it's got a new low of the year here. Amazon, higher high, higher low, and up by about 0.5% on the week. All right, Tesla's up by 2.7 so far this week. Lower low and lower high. So gap down, pump up, which is what? The sign of a reversal. So what are you telling me, Justin? Because everyone out there is saying that, oh my goodness, we so bear. Well, even in bear markets, we get bounces. And what's so important to remember, especially to have patience, is that the most violent, nastiest rallies happen in the bear market. Look at this day back over here. That was on February 22nd. And from the, excluding the futures trading, from low to high, the gap down pump up, that was a 4% day. Oh my goodness. That is right. Oh my goodness. So the most violent rallies happen in a bear market. And I am seeing technical reasons why we could be looking for a carve out of a bottom here. I'm not saying we are, not saying we will. I'm just saying I am seeing some evidence. So before we look at a few more charts, let's just try to get a good backdrop of where we are. So we are fish swimming upstream if we're bullish. I think I've made that story very clear. And as of right now, we are printing lower lows, lower highs, and the fundamental backdrop looks really scary. So if we think about this pattern right here, yeah, we're swimming upstream. I want to show you one thing though. Let's look here at the SPY 1 day and see whether or not we are hanging out around the lows or actually losing them. We got a bearish engulfing candle. So why can't they really punch us down to 350? Like, what's holding us up? I don't know. That's why it's bullish. So the last time we hit this lower channel here, or these red lines, it took a while to carve out this rally. We ripped up. There's your relief, and there's the fresh cut. So it looks like we need to see some relief for the bears to reposition, reload, and then take us down for that next leg. Because right now, we're actually stabilizing here. After we gap down, we're largely trading between 370 and about 360. So every previous time when we hit that number and it broke, we just waterfalled fast. So I forgot to show this before here too. So this green line here on SPY is going to be our 200 weekly, which means there's still a little bit of wiggle room. But when we look at QQQ, or the Qs, again, which is leading us, what do we have? Well, like we already hit that 200 weekly. We're already at the bottom of the pattern. Yeah, that's right. We're already at the bottom of the pattern. We cannot really afford to go much lower. Otherwise, Dow already below, Russell already below, the rest of the world already below. That's going to drag SPY down. It's going to make it fail. It's going to make the bear market continue even more. So when we look here, again, decreasing volume, stabilizing, is that enough? I don't know, right? I don't know. It closed up by 11 cents. This is actually a bullish engulfing candle, believe it or not. But since you guys like the full candles, that one's red. If we go here to a hollow candle, which Justin prefer, oh, it turned green. That's right. It turned green. It turned green. It turned green. So all I'm trying to say is that even though we are fish swimming upstream, we have to realize at what point, if we are bearish, it's no longer worth us being in. We have to wait for the chart to tell us it's time to re-enter. And a different way of thinking about the fish swimming upstream is this is the stock market psychology chart. I'm just showing you the blank chart here instead of actually showing you my overlay with SPY, Bitcoin, and ARK, just because I think it's important for us to just understand the concept. Not, oh, well, we're exactly right here. So we go all in long, and then we go all in short, all in long, all in short, because I don't want people to be trying to time every little tick. I think what's important to understand is just that once we start going down the bottom side here, it gets easier for us to keep going down until we don't. And the takeaway here is, again, going back to my my notes, until SPY can print a weekly higher high, there are just no longs for me. Those are hard pennies. Algo says to invest being short. Those are easy dollars. Yes, that's what this tells you too. I love this chart. It's really helped me after I really hurt myself really bad. And that's because I just didn't really understand what the market was doing. So hopefully these high-level notes will help you too. This right here is getting a lot stronger too. I'm not going to talk about all those things, but anyways. Another reason why we're due for relief. Are we going to get the relief? It's been hard to make the videos and thumbnails for the last few days because yesterday I actually wanted to talk about how I thought we could go for a gap fill and SPY. But then boom, by the last 10 minutes, we're like, oh, actually, let's take those gains away. Let's smash those beds. So here at 17, that's an extreme reading. Going to get more extreme? Absolutely. But here we are. We're at about 17. So we're oversold. We're carving a bottom. Carving, right? The bottom of the pattern is complete. We're either going to re-accelerate down or we're going to start to stabilize. If charts stop going down, and just right now, by going sideways, give it enough time, QQQ will stop going down. All it has to do is go sideways for a little bit longer, notably into the 5th of October. For SPY, we're looking at about the middle of October. So if we can just start going sideways for a period, that's probably good enough for relief. Here's the, excuse me. Here's the alternative. So when we think about the fish swimming upstream, and once we start getting over to this other side here, we have to also ask ourselves, who was really in control of the market? When I mean the stock market. Well, it's money managers. So money managers are going to be the ones who are managing the money. There's market makers, and then there's large institutions. Those are the ones who control the bulk of the money. So you have to ask yourself, are you feeling these emotions right now? Complacency. We'd have to just cool off for the next big rally. Anxiety. Why am I getting margin calls? The dip is taking longer than expected. The rally's taking longer than expected. Denial. Oh my God, my investments are with great companies. They will come back. Panic. Shit, everyone's selling. I need to get out. And then capitulation. I'm getting 100% out of the market. I can't afford to lose more. I don't see enough evidence to say we're at capitulation yet. VIX over 40, massive vol, scary headlines. That's what I need to see. I have to see people getting super confident bear too. We're not there yet. However, here's where if we do lose those lows, like I mentioned before, lose 390, right to 380. Lose 380, right to 360. Lose 360, probably going right to 350. And that means we're not going to look back. QQQ is going to be below its 200 weekly, along with every other ETF. SPY is going to join the club, and that probably means we're going to take a leg down. I've made my comparison back to 2008, and what it means is that we will get a chance to actually lose it, dead cat bounce back up, and then confirm we're bear if that's the move lower. I'm not gonna bore you by showing you what that means. It just means I'm not 100% convinced we're going into the next leg lower yet. We lose 360, oh boy, I will believe it. And I don't want to make the video too long, but I'll show you the options reason why at the end here. So let's just think about this. I'm going to show you a couple pieces of evidence that show us that we're starting to go down this route. And here's the first one. So U.S. housing prices fall for the first time since 2012. So this is published today. And for the first time, house prices went down. Say goodbye to the housing bull run. Oh, crap. Right? So why does this matter? Well, people don't get bids or asks on their house every second during the weekdays like we do on stocks. So they're going to find out when. Well, probably Q1 of next year. How do I know? I'm a homeowner. I get my my tax assessment and my appraised value based on what the government wants for their collection in roughly February, I think. So then I'll be like, oh my God, I lost this much on my house. Should I sell something else? That's where people start to feel scared. And that can self-fulfill. Anxiety. Oh my God, how's my house worth less? This rally's taking longer than expected. I thought housing was the safest investment. So this could cause more selling. I'm not saying it will. I'm just saying it's notable. First time in about 10 years. Now we look at this one here. Retail trading army is seeing power wane in stock market it once ruled. Retail trading at 17.5% of total vol, down from 24. Why? Boom! They blew up. Right? They blew up. I'm 1,000% sure that's why. People blew up. They don't have any more money, so they don't have any more trades left, which means the market is back to the way it normally works. You need to really appreciate that. Institutions, money managers, and market makers control the market. They always have. There was a small blip where retail took the reins, and now they don't have that anymore. They used to rule it very briefly, not no more. And the reason why this is notable is because they're now only starting to feel the fear. Let me see if I can actually find one more article here. There was this one here. It was about Canadians. I'll actually try to find it here as I am. I think I might actually have it up here. 1 second, because this is actually quite important. Retail is only looking to, retail is now blown up. So we're going to look at this chart here. Here's the article I want to look at. This is from today as well. Post haste, millions of Canadians are losing confidence in the stock market and plan to cash out. Again, plan to. They haven't yet. So what does that tell me? Anxiety. That's what they're feeling. They're going to sell at the bottom. They're going to sell when everyone else is. They don't hear that yet. And this is millions. So America's 10 times bigger. So pretend it said tens of millions of Americans are losing confidence in the stock market and plan to cash out. Well, they haven't done it yet. And they got to sell their mutual funds. They got to sell their 401ks or their RSPs up here. Man, this is going to start getting like really bad. It's going to self-fulfill. That's how we get to capitulation, where people say, I'm getting 100% out of the markets. I can't afford to lose more. We're not there yet. But now look at this graph here. You want to know why the market tanked in December and January? Because they were drilling it. They were raising money, right? Dry powder, total assets of money market funds. They've got $4.5 trillion on hand. They started raising money like crazy. And the reason why this is important is because they've had the patience over years to not do anything, right? They're sitting on powder. And that means that they're nimble. They're never going to be like, oh my God, can't afford to lose more. Why? They got 4 or 5 trillion sitting on the balance sheets here. And they've not deployed it, which means they're being opportunistic. This is really important because tomorrow we're going to be getting Jerome Powell speaking again. Today he was talking about crypto, moved it up massively. Now, I'm not sure what he actually talks about tomorrow. The calendar's been hard to follow lately. I'm pretty sure he's at a symposium talking with Bullard. So that's going to happen at about 10:15. Jerome gives opening remarks, and then we move forward. We've had so many Fed speakers today. I'm just going to ignore those. Right? We have so many more coming up here. We knew it was a Fed jam-packed week. So 2 more things I want to quickly go through. It's just going to be us looking at the charts in a moment here, but the cheat codes really are those sheets I showed you before with the Justin's notes, where until we can print a weekly higher high on SPY, there's no reason to be like looking at getting in long here. We also have to be aware that we've already printed 360. So we've hit, for me personally, my lowest level of support. It doesn't mean we can't go lower. It just means that's where I would expect us to bounce if we're going to be finding support. If we don't, hey, we could go to 350 in a hurry. I'm being mindful that I don't like shorting strong support. And right now, as long as 360 holds, it is relatively strong support. It is a very well-defined risk area. And because we're reclaiming, not reclaimed, last week's low at 363.29, we closed above it. That shows me progress. Is it enough? I have no idea. I don't know, right? London Bridge is falling down, and I don't know if I'm going to make it in time. I just know I can see the warning signs. Okay, so last thing we have to ask ourselves is whether or not they're holding up Apple, Tesla, Nvidia, and maybe a few other stocks for window dressing. If you're not sure what that means, tune in tomorrow. I will explain more of it. I don't have time on it today. So it means that every 3 months or 90 days, there's a quarterly rebalancing, which means that if you want to sell your big chunk of stock or you want to buy something else, you do that at the close on the 30th, which is going to be the last calendar day of the quarter. So what's been green? Apple, Tesla, Amazon, right? And let's just look at window dressing here. We'll read this really fast, and then we'll circle back and talk about it more tomorrow. But drop me a comment. Are Apple, Tesla, Nvidia really the leaders? Or is this just a mirage? Window dressing occurs when portfolio managers try to boost a fund's investment performance prior to investors or shareholder presentations. What I just show you from the Canadians. They're losing confidence. They haven't lost it. They're losing it. And if they don't window dress and make it look like, look, we got the best stock pickers ever. We bought, in the last 30 days, we bought Apple, Amazon, Tesla, Walmart, blah, blah, blah. Right? We're good. We're so good. They don't have to prove they made money on it. They just want to show they own it so they don't look like losers. So that's why this window dressing is so important. So if people are losing confidence, but they haven't lost it, losing, not lost, they have to make sure they do their best to try to window dress it, which means we might be seeing an artificial reason why these select names are holding up. And if that holds up, the Qs hold up. If the Qs hold up, SPY can hold up. It's that simple. And I think we need to fill this upper gap, whether it's this week, next year. I have no idea. I would believe the move lower if I could see a true rejection at 373. And that goes back here to, excuse me. Oh. Our bear market targets. And that's because before we even look at the chart, 378 is our 2020 high. So if we reject off 373, it means that we confirm we are below the 2020 high. We've already printed a lower low versus 2021 low. And now we are resuming down, which means we've rejected off the 2020 high. That's the Powell top. That's what I think. So I'm paying really close attention to it. Last things here. Why bull or why bear? Why bull or bear? Well, the bull case is not getting very strong, but that's why it could actually come up here. Because even with all the shit, pardon my French, but all the shit we've been reading about all around the world, in Europe, in the UK, in Japan, right, in Canada, in America. It's bad everywhere. But somehow, the lows are holding at 363, or roughly 1% above 360s. Is that just for a different reason? Or is it because maybe the shorts are covering, like I showed with the net short positions on the futures getting wound down a little bit on Friday? All right, one more quick thing to look at, and then we're going to leave it here. The reason why, if we lose 360, I'll be paying so close attention to it is because, excuse me, on the 30th of September, we're going to have the quarterly expiry. The quarterly expiry is actually on SPX, but there's actually more volume on SPY, so I'm focusing on this here. And this is unusual, but again, we see a lot of volume here. So what people are really betting on is that 360 area, which so far is held up. So this 360 area tells us what people need to get for them to get their money back on Friday, because there's all this open interest. So with the open interest here, it means that there were, so 120K, add 2 zeros, which means we got 11 million. 11 million times 4, roughly $50 million is tied up right here. And they held overnight. For them to get their $50 million back, we have to be at 360 minus 360. So what does that mean? Well, it means that we have to be 1% below this area for them to get their money back. We have to be at basically 357. So at 357, where are we? Oh, God. Why do you got to do all that technical analysis stuff and show me? Well, 358 is our 200 weekly, which means they think on Friday close, we're going to be below our 200 weekly. That's what they're betting on. Are they right? I don't know. But if we lose 360, like I've mentioned, it's probably going to be a magnet where we're going to start going down. So with that said, if you want to know more about how the bears are making history and they are continuing to drill us lower, I encourage you to watch the video that'll keep up here in a moment. Otherwise, thank you so much for watching, and I look forward to seeing you tomorrow. Thank you.